Joining the program right now, Robb, senior reporter with MarketWatch. He's been covering this story really ever since last week. Greg, thanks so much for being with us. You know, I have so many questions. It seems like there's so many competing headlines of this story right now, one of which the U.S. Treasury says it will back deposits beyond the federally insured ceiling of $250,000. The Treasury said depositors will have access to all of their money starting today. That's unusual, is it not?
Oh yeah, it's unusual. It's a bazooka. The Treasury and the federal regulators in Washington really didn't want this bank run out at Silicon Valley Bank to get out of control. They were worried about contagion, so they kind of moved in with a lot of force. And you know, I think it's going to be successful. I don't think we'll see too many more bank runs. Well, you know, it's always hard to predict the future, but the Federal Reserve set up a new program, a loan program, so that any banks that kind of feel this pressure of depositors wanting to take out funds, which is what a bank run is, can go to the Fed and get some cash to pay off those depositors. That's supposed to cool everybody down until cooler heads prevail. The program lasts for a year. And they did some pretty serious stuff over the weekend.
Do you think what we're seeing, I mean, would you characterize it right now as bank runs? I was just showing some of the video you can see here. This was in Santa Clara today, this morning. Do you think it rises to that level, that definition right now?
Yes, I do. It's interesting. It's not like the 2008 financial crisis that we all know and love which was caused by mortgage-backed securities that nobody knew the value of. This is caused by, as your reporter said, they had too many treasuries. The Fed was raising interest rates, so suddenly their balance sheet was kind of upside down. And it's interesting you're showing pictures of people outside the bank, but this run really came on people's phones. Silicon Valley, it's a close community. They know each other. They all texted each other.
Oh, wow.
And they all said, "Did you hear about the trouble at Silicon Valley Bank?" And they all just started taking their money out so quickly that the bank, which, you know, has a lot of assets, just couldn't respond. The government stepped in, took them over in the middle of the day, something they don't like to do, last Friday. And then over the weekend, they worked up this plan. They're still looking for a buyer for the bank.
Yeah. You know, there seems to be two competing theories right now. You mentioned the cause. Let's go into some of the causes.
Sure.
Is this a regulatory failure, do you think? Or is this a case where, you know, these head honchos at the banks, you know, kind of miscalculated some of the risk? They didn't see these moves by the Fed with such high interest rates. And that's where this maybe all started from.
I think this is one of those cases where we're going to have to keep a lot of different ideas in our heads at the same time.
Okay.
Both of those things you said are true. This is definitely, a friend of mine put it really well. He said this is a black eye for regulators. This is sort of regulating 101, to look at people's balance sheets to see if their portfolio of all their assets is suddenly underwater. So that's a trouble for regulators. And the Fed has said they're going to do an investigation of this and do a report by May. So that'll be interesting to see. But it's also, it looks like it's harder to know right now. We're only getting glimpses of what the banks were doing. And a lot of people, you know, on Twitter all weekend were sort of people who I kind of judge their opinions. I value their opinions, were sort of pulling out their hair saying what was going on at that bank. So we have these two things going on at the same time.
Yeah, I want to read from this statement. This was a joint statement just yesterday by the Federal Reserve, the FDIC, and Janet Yellen at Treasury. The last paragraph says, the U.S. banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. Those reforms, combined with today's actions, demonstrate our commitment to take the necessary steps to ensure that depositors' savings remain safe. Now, Greg, we're hearing from White House officials. They are really going to great lengths, saying, no, this is not a federal bailout. Depositors will be made whole. But where is that money coming from? Does the Treasury Department just have this vast amount of reserves where they can shore it up, they can safeguard it?
The money, if needed, the money will come from the Federal Reserve, which
Okay.
can borrow money and create reserves in the banking system. That's a long story. But I think the big thing to think about is the word bailout is very loaded. I'm getting feedback, but this wasn't a bailout in the sense that shareholders, people who had stock in the bank, people who had bonds of the bank, are not going to get repaid. So that the Biden administration is holding on to that as a not being a bailout. It's just a loaded word. It's a rescue. It's a, so you can use it or not use it depending upon what you want to do. I think the arguments can be made either way. It's sort of like, I don't know how to say it. It's sort of icing on the cake, or just it's a sideshow.
Okay.
Because what's happened is a bank has collapsed.
Yeah. Greg, just lastly, you talked about contagion. The graphic says, is this a domino effect? We were seeing some banks over the weekend, and even today when trading opened, their stocks kind of plummeted. First Republic Bank, other banks. Is it your view, and maybe among some of your contemporaries who cover this each and every day, that other banks will fall or are on the precipice possibly, or no?
You have to kind of separate the banks. The nation's biggest banks, they're called systemically important banks. I think there's 25 of them. They are ring-fenced by the Fed and are watched very, very carefully. So you have to put them to the side. This doesn't look now like that this is going to penetrate those walls that the Fed has built around those banks. Now, the banks we're talking about are these regional banks that are kind of too big to be community banks, but too small to be, the Bank of Americas of the world. So those banks today, all the shares, investors were having to figure out, do I want to hold this stock? Do I don't want to hold this stock? Are their bonds going to be worth money? What's going on at these regional banks? Congress a couple of years ago gave the green light. They really wanted the Fed to ease regulation on those banks. The Fed did ease regulation, and now we're trying to figure out how healthy those banks are. Yeah. So that's where the action is, and we're going to be watching the metrics of those banks. I think the government just really wants this to kind of calm down pretty quickly. Okay. And if it does, they'll be happy, and if it doesn't, they won't be happy.
Okay, I said last question already. I had one more that I had written down here because if you're, a Silicon Valley startup CEO, if you run a VC fund or firm, why do you think so many of them were so concentrated in this one specific bank? Why do you think a lot of these startups possibly didn't diversify and maybe they wouldn't be in the mess that they are in right now? What does that say to, I guess, the startup culture writ large, maybe?
I mean, I think it's somehow, we're going to find out that answer to that question. That's a great question. Yeah. Right now, the theories are that it's sort of like a country club, and that it wasn't sort of a bank, but it was more of a country club in some way, so that people wanted to be there, so they kind of were happy to be there, and they weren't giving due diligence. And I guess when you have a startup and you get money from somebody, or venture capital gives you money, the venture capitalist says, I want you to use my bank. I guess 9 times out of 10, you're going to say, why not? You want to have a really good relationship with them. So they put their money in there, and it kind of just keeps going and going. Yeah. But that's going to be one of the, we're going to get to the bottom of that, for sure.
Greg, Robb, we appreciate your reporting, your insight into this, and we'll speak again. Thanks so much.
Thanks for having me.
All right, in the meantime, we do want to show you President Biden's remarks from the White House before he left for his trip to California today, assuring Americans, assuring depositors, investors, and a lot of people that the U.S. government has this under control. Here are the president's very brief remarks on this banking crisis.
Before I leave for California, I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will, this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed. On top of all of it, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4% for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
Okay, some reporter questions there. Karine Jean-Pierre was asked about this as well on Air Force One to California today. She said President Biden spoke with economists over the weekend, and we just heard from President Biden from earlier this morning before he left for California. Live Now looked there at the White House. There are still so many questions. We want to talk about this even further. What are the legal implications for banks like this in the event that some of their depositors don't get all of their funds that were with these failed banks? Let's talk about that even further with former federal prosecutor and legal analyst, friend of the program, Doug Burns, joining us from New York. Doug, thanks so much for being with us. So, first of all, I think this might have taken some people by surprise. Two banks now. One, the 16th largest bank in the country, Silicon Valley, going under. Just last week, Signature Bank going under over the weekend. You know, if you would have told me this would be maybe have been a byproduct of high interest rates and inflation, I don't know. I would have been still quite shocked. What are your overall thoughts about this? And then we can get into the legal implications.
Well, yeah, you have like the political discussion and the legal one, of course. Obviously, you know, we've heard the political rhetoric and the sound bites and stuff, and not really so much my area. You know, each side claiming it's the other side's fault. It's interesting, though, because I do have to call out President Biden Barney Frank himself, named individual from the Dodd-Frank law, was on the board of SVB, by the way. And when some of those adjustments were made, which I'll get into a little more in a few minutes on the FDIC protection stuff, in the previous administration, Barney Frank was all in favor of it. So that's all I'm going to say, is just to say that, right away, everybody comes out with political rhetoric. Legally is 10 times more important. Basically, the FDIC, the Federal Deposit Insurance Corporation, is the key, of course, to everything. They insured bank accounts starting in 1980, by the way, up to $100,000. That was upped in 2008 to $250,000, $250,000. So there's, good, strong protection in there. But I heard your question, which is, what if there are shortfalls? Now, that would have been a harder answer for me to address, and it's easier. And here I'll give President Biden some credit. He's saying that they're going to work as hard as they can to arrange a situation where even if it's above that amount, it'll be covered. Again, we can crisscross back and forth into politics. That causes, pundits on the right to immediately come right out saying that's disgraceful. The American taxpayer is going to pay for it. Those are gross overgeneralizations. Basically, The FDIC is like any other insurance. I'm not being cute, but if you have a bad car accident, often your rates go up. So it's the same thing with the FDIC, Andrew. In other words, if there's needed funds to make whole here, then the rates to participate in the FDIC program as an insured may go up. But the good news, as far as I can tell, is that the overall Biden philosophy, you can like it or dislike it, but the good news about his philosophy is he's going to make sure everybody's made whole, in my opinion, which is a really good thing.
I know. I'm kind of curious, what former Senator Chris Dodd, former Congressman Barney Frank of the Dodd-Frank banking regulations passed post-2008, what are they thinking today? I'm also kind of curious if, people who have watched this like yourself, and we're still really in the thick of this story. I keep asking questions to everyone we're bringing on, and, this could change and hopefully no more banks fail. But do you think there's this 2008, I guess I would call them jitters in the ether, or no? The White House is saying no.
It's hard to say. In all humility, I'm not really the expert on why this necessarily happened. But at the same time, I follow what's going on. And, apparently, obviously, the interest rates were extremely low out of the Fed. And banks, which already take a lot of risk, everybody knows that. I've heard all the economic pundits pointing that out. This particular bank, SVB, I'll focus on them more. They went into some risky investments. I heard the experts describing them as, long-term treasury bond investments, which apparently are negatively impacted once interest rates are raised. Again, that's a little above my pay grade, but the point I'm trying to make is that that's really what happened. Part of it, too, I think, is the infusion of vast amounts of money into the economy. You've heard all kinds of economic experts talk about that. That can cause some inflationary pressures and spiraling, and many are claiming that also had to do a little bit with what went on here. Okay. But again, the good news is that the FDIC program is a strong one, fortunately, for everybody.
Yeah. Doug, just lastly, if you're a depositor, you do business with Silicon Valley Bank or Signature Bank, obviously those banks now await some type of buyer. But say the banking infrastructure at these regional banks, basically falls to the wayside. The board resigns. The leaders of these banks are replaced. But if you're a depositor, can you still take legal action? Or what if you get all your money back? Is that even worthwhile doing?
That's a good question. I mean, apparently there's already a class action. That's not surprising.
Okay.
And the class action is going to allege on behalf of many, many people, that there was waste and mismanagement by the bank. Not entirely clear where that will go. But your question's a very good one, because the way it's going to play out is if people get their money back, then they're made whole, and that'll be pretty much the end of it, it seems to me. And if not, the other related legal question, I suppose, is, employment. I mean, basically what happens is the FDIC enters into sort of a purchase/takeover agreement. Then they enter into agreements to make depositors whole, get them their money back. That's a process. That's an FDIC process. And then, interestingly enough, the answer to my legal question about everybody's employment also got a little easier, because normally, if you don't have a written employment agreement, and the bank fails, you're basically out of luck pretty much. But here, the FDIC, again, in a good way, is stepping in. And what I heard and read and was listening to is that they're going to offer employment for the next 45 days, even at a 1.5 wage rate and all of that. So again, it does seem that there are positive reactions to it, but you're going to see the intense political disagreements over why it happened.
For sure. Doug Burns, as always, we appreciate your insight into these major headlines, and we'll talk again. Thanks so much, Doug.
Appreciate it. Thank you, Andrew.